All right, welcome to Talk Tickers. Today we are digging into the first quarter earnings for Lucky Strike Entertainment. That's ticker LUCK. Now, on the surface, everything looked great, a really solid beat. But the market's reaction, well, that told a completely different story. So let's get into it and figure out what's really going on here.
Okay, here's how we're going to break it down. We'll start with what I'm calling the earnings paradox. Then we're going to deep inside the numbers. After that, we'll look at the story management is telling, try to decode that weird market reaction, and of course, wrap it all up with our final take in the next call.
And right here, this is the whole puzzle in a nutshell. I mean, look at this. Lucky Strike beat on revenue, they beat on adjusted earnings per share, and they even raised the dividend. You'd think that's a home run, right? But after all that good news, the stock actually traded down 1.1%. So what on earth did Wall Street see that the rest of us missed in the headlines?
Let's start by unpacking those headline numbers because, on paper, they looked pretty darn strong. Now, when I say strong, I mean it. The size of the beat here was pretty significant. Revenue came in at almost $293 million. That's a full $10 million more than the analysts were expecting. Adjusted earnings per share, it was a small loss at 12 cents, but that was still 3 cents better than feared. And here's the kicker. Adjusted EBITDA grew a really healthy 15% year over year. I mean, you look at this and you think, wow, what a great quarter.
But as soon as you pop the hood and look at the engine, a much more complicated picture starts to emerge. It turns out the market was zeroed in on some of the conflicting details hidden way down in the report.
And this slide right here, this explains everything. It's the central tension of the whole story. You see that impressive 12.3% top-line growth? Well, it turns out that entirely came from buying new locations. The core, organic business, what we measure with same-store sales, was actually down. Not by a lot, just negative 0.4%, but that's the number that set off alarm bells for investors.
So you have to ask, what was dragging that number down? And what's so interesting is that the regular consumer business was actually doing just fine. Walk-in retail was up 1.4%, and league revenue was up a strong 2.1%. Nope, the whole problem came from one place: corporate events. That segment fell a whopping 11%, and they blamed it on weakness in the tech markets out in California and Washington. But, to be fair, management was adamant that a turnaround is already happening, saying that October was their best month for events in over a year.
Now, while all that corporate stuff was looking soft, there was one area that was on fire: food and beverage. Revenue there was up a massive 10% in the quarter. And here's the really cool part they shared on the call. That growth wasn't because they jacked up prices. It was driven entirely by higher attachment rates, which is just a fancy way of saying they got more people to actually buy food and drinks.
And you could tell management is just incredibly bullish on this. You can hear it in this quote. They're all in on improving food quality, trying new things like a pizza and pitcher combo, and just getting better at selling. They basically said they haven't even scratched the surface of what's possible here, which signals this is going to be a huge focus for them going forward.
So, okay, this all leads us to management's big picture strategy. They're not just sitting around waiting for business to get better. They are actively out there trying to reshape the entire company.
And their plan is pretty straightforward. Really, it's got 3 key parts. First, they're just getting bigger, buying up other companies. They added 4 new properties this quarter alone. Second, they're taking all these different brands they own and unifying them under the high-end Lucky Strike name. They think that'll help them sell more of that food and beverage we just talked about. And third, just like we saw, they are pushing like crazy to grow from within, with F&B right at the top of that list.
Now, you've probably heard management use the word accretive a bunch on their call when talking about these deals. For anyone who's not familiar, that's just a bit of finance jargon. It simply means that they expect these acquisitions to actually increase the company's earnings per share. So the takeaway is they're not just buying growth for the sake of getting bigger, they're buying businesses they truly believe will make the whole company more profitable.
And while they're out there spending money on new locations, they're also making some really smart moves to shore up their finances. I mean, think about it. They raised the dividend by 9%. That's a huge vote of confidence. They did a massive $1.7 billion refinancing to push their debt way out to 2032. And get this, they spent over $300 million to buy the land under 58 of their own centers. Why? To control their rent costs for years to come. These are not the moves of a management team that's nervous about the future.
So you put it all together, the earnings beat, the dividend hike, the smart long-term strategy, and we're right back where we started, asking that central question: why was the market just so meh?
I mean, this is really the key question for anyone thinking about investing in Luck right now. What is causing this massive disconnect between what seems like really solid execution from the company and the stock's pretty crummy performance?
You can really frame this as a classic Wall Street battle between two competing stories. On one side, you've got the bulls. They're looking at that awesome F&B growth and the smart acquisitions and saying, this is a winning formula. They see the rebrand unlocking a ton of value and that dividend hike as a sign of pure confidence. But then you have the bears, and they just can't get past that negative same-store sales number. They see a weak corporate business, they're worried about all the debt they took on, and they'll happily point out that the stock has been a real dog compared to its peers all year.
And so, here's the verdict. For right now, the market is voting with the bears. It's sending a clear message. We care more about the weakness in your core organic business than we do about the growth you're buying with acquisitions. Basically, investors are on the sidelines waiting for proof that same-store sales have stopped bleeding and are finally starting to grow again on their own.
All right, so that brings us to our final segment. Where do we go from here? What should we be watching for next quarter, and what's our official call on the stock? Okay, here are the 4 things you've absolutely got to watch. Number 1, remember they said October events were strong? Well, did that carry through the all-important holiday season? 2, how fast are they moving on that rebrand program? And are the newly converted stores actually doing better? 3, and this is the big one, can they finally get that same-store sales number back into positive territory? And lastly, how are those new water parks and entertainment centers fitting into the bigger picture? So our official call on Luck is market perform. Look, the whole story here boils down to one single metric, same-store sales, period. The acquisition strategy is working, their F&B game is fantastic, but until the market sees real, sustained strength in the core business, we just think the stock is going to tread water. It's unlikely to get that big re-rating higher that bulls are hoping for.
Okay, and now for our outrageous but plausible trade idea. So, hear me out on this one. You could consider a pair trade. Go long on Luck stock, but at the same time, short a broad leisure ETF, something like PEJ. Here's the logic. Luck is trading cheap compared to its rivals, specifically because of those same-store sales worries. If, and that's a huge if, they can fix that number and get it stable, or even slightly growing, the stock could seriously outperform the whole sector as that valuation gap closes. The short on the ETF is your hedge. It protects you if the whole leisure industry takes a hit from a weak economy.
And as always, this is not financial advice.